Welcome back. You're watching Stock Picks, and as we near the year's conclusion, today we dissect stronger and weaker performers of the year. That's Harmony Gold, Textainer, Truworths, Transaction Capital, Mourx and Roberts, as well as Impala. All this and now with FNB Wealth Investments, Chantal Marx. Chantal, it's always a pleasure. Good afternoon to you.
Hi, yes. What a fun show. I mean, it's really great to look at which companies did well during the year, which ones underperformed, and to unpack why. Because in this way, you can see whether or not you need to take money off the table or potentially put money on the table where those losses have perhaps been too large.
I'm actually keen to start with the winners. Let's possibly start with Harmony Gold. I didn't see this one coming, I'll be very honest. And also, it hasn't been an even picture with all the gold miners. So you can't even say that it was a gold mine boom.
Well, yeah, I mean, it was definitely driven by a higher gold price. And for Harmony Gold, they're a more marginal producer, which means their cost of production is quite high. So when the gold price increases quite nicely, the impact from a profitability perspective is a lot larger for Harmony Gold. What we've also seen with Harmony more recently is that they have been improving their operational performance. They've also added Anglo Gold's old South African assets to their portfolio. They're expanding offshore and into copper. So the investment case has tilted a little bit and de-risked slightly away from just the kind of old deep shafts that they owned a couple of years ago. But these gold miners are super volatile. Gold miners don't make you money over the long term, but they are excellent to trade. And I think that Harmony Gold was just a prime example of that this year.
It is interesting if we take a look at Harmony Gold, because another thing they said is they've managed to keep their capex reasonably stable at this time. This is something you don't hear of often, specifically because we were in this high cost environment. Is that also due to that operational, improvements that you're making reference to?
So I think that the focus on cost is definitely there. So already when you naturally have a higher cost of production, you need to be very, very tight in terms of how you manage your costs. Add to that a high inflation environment where wage costs are also still increasing quite meaningfully. And you really have to focus on the controllable issues there. And I think that the company executed quite well on that. And I mean, across the JSE, you can see that there are a lot of companies that manage to contain their costs below inflation or around about inflation, and in that way actually driving margin gains. So I think that it's kind of a sign of the times as well, where top line growth necessarily isn't there, so you need to focus on the stuff that you can control.
And then I'd like to move on to Textainer, because it's a company we don't hear about often. To my understanding, Chantal, it's going to delist from the JSE, and I'm wondering how that's all played into the performance.
Yes, and this is why I wanted to talk about this company particularly, not necessarily because of Textainer and its underlying fundamental. I mean, it's going to delist. We need to wave goodbye to the stock. But I think there's a general trend among the mid-cap stocks in South Africa, and it has been in place for quite some time, where they are exceptionally undervalued. And then a suitor steps in, either a multinational or a local competitor that decides to take out these stocks that are trading at such a discount. I mean, some of these companies really shouldn't be trading on 2 or 3 times PEs. That is exceptionally cheap, even at this point in the cycle. And many of these companies are exceptionally well run, with Textainer being an example of that. So in the absence of a re-rating in the market and it being more appropriately priced, they're going to get taken out. And Textainer was a prime example of that more recently.
You've said it. A lot of our mid caps are susceptible to this trend of being bought out. Chantal, does that tell us that South African businesses actually are well run? Our executives do know what they're doing, but maybe it's institutional investors that don't quite see the value?
So I think that the volume constraint is there when you're thinking about the institutional investment space. And while our retail investment space has been growing, particularly when it comes to kind of self-managing your share portfolio, I think that it's still in its infancy. Retail investors in South Africa are perhaps following the herd rather than kind of digging for those opportunities themselves. So sometimes they just don't notice some of these names, or they see a company like Zeda, for example, being unbundled from Barloworld, the share price dropping quite substantially right after the listing, and then deciding to not even bother looking at it. So I think that for the small and mid-cap space to thrive, we need to really start seeing retail investors become reinvigorated around the stock market, and start digging a little bit deeper, because I think that that's where the opportunity lies for them, and it's more accessible for them relative to a big institutional fund that will take several days and weeks to trade out of one of these small companies if they need to.
Very interesting one, definitely with Textainer. Truworths also an interesting one. I'm more surprised by Truworths, Chantal, because they're 70% credit sales. So in my mind, Truworths sells clothes, but they also sell credits. But of course, they've managed to weather the storm better than cash retailers, actually.
Yeah, so we're in that point in the cycle where the story actually benefits the credit retailer. We're probably getting close to the end of that, so just beware of that when you're circling around Truworths. Firstly, Truworths was exceptionally undervalued at the start of the year, so there definitely was a re-rating there, trading closer to its peers now on a relative valuation basis. And then the second thing is that credit retail cycle, the credit cycle really benefited it, because consumers' disposable income has been under pressure because of higher inflation, perhaps higher interest rates resulting in bigger mortgage payments. They've taken up consumer credit in the form of kind of store credit. They are buying more on credit in order to meet their basic necessities, and in this case, particular clothing and footwear. So, I mean, a year ago, if you looked at Truworths' credit book and the available room on that credit book, so in other words, say I had a Truworths account and I can borrow up to 10,000 Rand, I would have only had about 4,000 Rand in credit there, which means I still had capacity there. So a lot of consumers started using up that capacity, and that was very positive for Truworths from a revenue perspective. And Truworths hasn't been too bold in extending credit, so its credit experience hasn't been too bad either, which means that the credit sales actually translated into cash flows for the company as well. But things are getting a little bit hairy right now. So I think that the party may be over for Truworths, at least relative to the other retailers near term.
Just out of curiosity, Chantal, is that revenue recognized upfront, even if it is a credit sale? And then, of course, if there's an impairment, that is recognized a little bit later?
Yes, they would utilize accrual accounting. So they would recognize it in the period that it was that the sale was made, and then they'll adjust for it afterwards based on the credit experience.
Very interesting, that one, considering also how Mr. Price has done this year, which isn't as great, and they're more pure cash play. Let's move on to the weak performers now. Transaction Capital. It's been a rough one for Transaction Capital. I think that's down 80% year to date.
Yes, this company really stands out among the weak performers. They had a very nasty experience with a sharp deterioration in the operating environment that SA Taxi plays in. They had to cut that book down meaningfully. They had to change that business because it didn't make sense for them to run it the way that they were running it before. And that pressure on the taxi industry has been sustained. At the same time, you had WeBuyCars coming under cyclical pressure because used car sales generally came under pressure. Affordability of vehicles, a big ticket item, generally became an issue because of high interest rates and high inflation and low disposable income. So it was kind of a perfect storm for the company. Add on to that some frowns around management transactions in December, just before they actually announced this. And you had a situation where not only were investors disappointed by the operational performance of Transaction Capital, but also in the transparency of management. And once there's that kind of trust deficit, it takes a while for investors to come back to the company and to really back the management team. They've made some changes at the helm. But I think a proper recovery will probably only happen once you start seeing the poor results from SA Taxi and the weaker results from WeBuyCars come into the base into next year. That said, I do think there is some upside there. But yeah, as I mentioned, that re-rating trigger is not here yet, and it could be a bumpy ride.
I must ask you, Chantal, when we think of SA Taxi and what it could look like in the future, I mean, in my mind, nobody wanted to fund taxi owners and taxi drivers for very obvious reasons. So transaction capital saw a market and went for it. But there was also a high risk, high reward, I think, approach to the interest rates that they were seeing coming out of this industry. And that, I think, has then also played into the sustainability of the model here. Is there a way to balance it? Because the SA taxi industry remains precarious, and that consumer, that specific consumer, remains a risky client.
So I think that the opportunity is still there. And I think that what transaction capital was doing was actually managing that risk reward quite well. I think what they didn't see coming was a worldwide pandemic resulting in capacity destruction and a real pressure on taxi owners during that period. I mean, it's the same with any business. If your revenue is coming down sharply, 80–90%, how are you going to service your debt? It's a natural knock-on impact. And then once you've now actually sold the vehicle, you've gone into, well, your credit is gone because you've defaulted on your payments. How are you going to restart that business again? So I think that longer term, there is still a place in the market for SA Taxi. I do see them recovering over time, but it can take a very long time. And then you also have to consider, is PRASA going to be in the state that it's in forever? Or are we over the next decade going to see an improvement in passenger rail? Because if that comes through, then SA Taxi is probably going to remain a much smaller business longer term.
Very interesting dynamics playing themselves out. Then let's talk about Mourx now. This sector also hasn't had the sector, it's the whole sector. I mean, every time I read on Roberts, I'm surprised because Roberts seems to be doing pretty okay, but there also seems to be an outlier.
Yeah, so I mean, Roberts has the advantage of being very geared towards road construction. And by and large, road construction has been performing better from a tender activity perspective, both in the private sector and in the public sector. Although they've mentioned that they've seen a slowdown in terms of SANRAL tender activity more recently, and Roberts also has exposure to the materials space. So even if they're not winning the tenders, they're supplying the materials to build the roads, right? For Mourx, they're exposed to contract mining, which generally is quite solid, but it is volatile to a certain extent. And then to big civil contracts or civil projects that haven't necessarily come through at the pace that they would have liked it to from a government perspective. And then there's Australia, right? Australia, not so maiden fair. They've really struggled in that market because the contract provisions that you have to put in place and the difficult environment when it comes to actually negotiating around that contract once these projects are completed, and that whole arbitration system is just so detrimental to the big construction companies. So they end up paying so many penalties for mistakes that were perhaps outside of their control that it just doesn't make sense for them. They complete these projects at a loss. So they actually put their Australian business in business rescue, and they lost the contracting mining business in Australia as a result because it was part of the same entity. So now Mourx is a much smaller company. They had a lot of debt still on the balance sheet. So they're trying to get that down. But I think that the share price slump is a reflection of all of these things playing out at the same time once again. And similar to transaction capital and SA Taxi in particular, you're probably just going to have to right-size that business, make it smaller, and then take it from there.
I'm going to move on to Implats now as well. Of course, we had some very sad news coming out of Implats today, but Implats won what people were calling a trade war for a Royal Bafokeng. They won that, but it still hasn't been a good time for them. In fact, maybe they have a new asset on board, and that had the markets even more concerned about them.
Yes, I mean the platinum and palladium and rhodium price for that matter. Well, the PGM complex has been under a lot of pressure from a pricing perspective, and this bidding war took place when prices were much higher. So Implats ended up paying a lot more for RB Plats than it would have paid for Royal Bafokeng Platinum if it had bought it right now. Their balance sheet is now a little bit more geared. And this is the wrong time to have gearing on your balance sheet and to make a big acquisition. Well, short term, it's probably the wrong time. I think longer term, there's still scope for a recovery here once PGM prices start forming a base and hopefully push higher. But it really has been the perfect storm for Implats. I think just the wrong time for them right now, and this year's share price movement is just a reflection of that. And I actually feel so sorry for the company, the management team, and the employees at Impala Platinum following the news this morning, because on top of everything, there's been this incident as well, and that will likely limit production for the next couple of weeks and have a further deteriorating impact on revenue and profitability for the year.
Chantal, I must ask you, what could possibly drive up a recovery in PGMs? We're seeing an oversupply, we're seeing demand waning a little bit. What kind of market conditions would we have to see for a turnaround of PGMs?
So one of two things need to happen. Either supply needs to come down, so it needs to become uneconomical for recyclers to continue recycling, or you will have shafts become depleted or closed down because you can't mine it economically at these current prices, right? The other thing that can happen is demand can rebound. Now, either that is driven by economic growth, because and then that in turn drives higher vehicle production, investment demand, jewelry demand, all the rest of it, or new technologies. So platinum is quite, or PGMs are an important component in hydrogen fuel cell technology. I think if that goes mainstream, you could see a resurgence of demand. And more recently, sodium-ion batteries have started to become more of a thing relative to lithium batteries. So lithium obviously is quite difficult to mine as well, and there are knock-on impacts there. But in sodium-ion batteries, I think your mining component is a lot lower, but that mining component is PGMs. So something like that could actually help them. But I think, yeah, near-term things are looking a little bit tough for the PGM space.
Well, Chantal, it's all we have time for today. It's been great speaking to you. Thank you so much for unpacking these counters for us. Very fast-paced, but fantastic as always. Thank you for your time. That was FNB Wealth Investments, Chantal Marx.